The Responsibility of Investing is a podcast by the PRI, the world's largest global body on responsible investment, representing over $128 trillion in assets under management. Each episode features conversations with thought leaders and experts from around the world, exploring how sustainable factors are transforming the investment landscape. This series helps PRI signatories and the wider investment community navigate responsible investment with greater precision and confidence for the benefit of both investors and society.
Hello, everyone, and welcome to PRI's podcast series, The Responsibility of Investing. My name is Cambria Allen-Ratzlaff. I'm the Chief Responsible Investment Ecosystems Officer at PRI, and it is such a pleasure to welcome you to our episode today. I'm joined today by Jonathan Grabel, the Chief Investment Officer for the Los Angeles County Employees Retirement Association, or LACERA. LACERA manages $90 billion on behalf of about 195,000 beneficiaries in Los Angeles County. Thank you so much for joining us, John. Before we jump into the nitty-gritty and the details of our conversation today, I thought it'd be interesting for our listeners to hear a little bit more about you, specifically starting with what drew you to the field and for dedicating your work to beneficiaries and public service.
Cambria, it's fantastic being here with you. Thank you for including LACERA, for including me in the podcast series. The PRI is an important organization to LACERA and our mission to paying the benefits to our our active and retired beneficiaries. So once again, thank you. I'm really excited about our conversation. In terms of me, there's really not much that's exciting about my background or why I'm here, but maybe that is the exciting thing in and of itself. And yesterday I had lunch with our summer interns, and we had this discussion, and the basic takeaway was let life happen. To the extent you can let life happen, allow it to. And that, I started my career, as you mentioned, as a CPA, working for, at the time, one of the big six accountancies, knew nothing about private equity. And my first client happened to be some private equity firms. And I was like, this is kind of more interesting than what I'm doing. And, the route to do that, which I deemed to be more interesting, was by going back to business school. So I went back to business school, and the economy was maybe, had a moment. And I, ultimately got to private equity through a stay in investment banking. And then through that, ultimately got to where I am now. I kind of let life happen.
That's wonderful. Thanks, John, for sharing that with us. So let's dive in a little bit more into the conversation, a little bit more into your role and what you do with LACERA and what your approach is. But before we get too deep into the weeds, when we were prepping for this discussion, we talked a little bit about the importance of terminology. And we are certainly in a field in responsible investment, ESG, sustainability, what have you, where we use a lot of terminology, we use a lot of acronyms, but we're not always necessarily talking about the same thing. So perhaps let's start level setting on the terminology. What do you call it? Is it responsible investment, sustainability, ESG? What does that mean?
We have at LACERA a dedicated stewardship team. Mm-hmm. So it's corporate governance and stewardship. And we have a separate board committee focused on corporate governance and stewardship. So I'd say those are the words that we use. And I agree with you in that words matter. And maybe we focus too much on the headline as opposed to the meaning, and we allow people to interpret things differently without really parsing the meaning of what we're trying to do. Because I doubt any institutional investor wakes up in the morning and says, I want to be an irresponsible investor. everyone should always try to be responsible. Responsibility is 100% aligned with being a prudent fiduciary.
100%. And let's talk a little bit about fiduciary duty. What does that mean for LACERA? How does that manifest in the way that you approach management, investment policies, and what have you?
Every decision we make is driven by our fiduciary duty to our members. And it's kind of a period full stop, type of statement. And so that means that if we have the privilege of overseeing an institutional pool of capital or several pools of capital, one that's going to pay healthcare benefits and the other retirement benefits, that we are focused on generating the highest risk-adjusted return while looking to defray expenses as well as contributions from current active employees and the plan sponsor. So being a prudent fiduciary means that we need to asset allocate in a way that accomplishes that mission, to not just put all our eggs in one basket, but to be prepared for multiple economic states. So that's our primary investment belief, is the importance of diversification. It's also important as we implement that to make sure that we underwrite and account for as many risks as possible. And historically, if I go back to, the arc of my career or the beginning of it, people were focused more on investment risk. It was all about, investment risk and volatility. Then you weave in things that emerged, accounting risk. You would later on weave in things such as cyber risk, and all these incremental facets, avenues of diligence made for better, more thorough underwriting to make sure that you're compensated for risks. And maybe an incremental pillar of diligence that has become more pronounced and relevant over time is the importance of stewardship, is the importance of people, specifically the talent, the human capital that effectuates the outcomes. So all those aspects are critical to fiduciary duty, and LACERA says so in our primary document, which is our investment policy statement, that all these aspects of diligence matter, and we're compelled by our fiduciary duty to be as expansive and holistic in our underwriting as possible.
Thanks, John. I love that phrase that you use, guides and compels. It's really powerful. So you mentioned LACERA's investment beliefs. Can you tell us what those are?
I've been at LACERA since 2017, so I take no pride of authorship of the investment beliefs. The board adopted investment beliefs. They started the process in 2015 or so. I'll take a step back in that an investment policy statement is something that we look at, called every 3 years, when we update our strategic asset allocation, which is the apportionment of assets across major asset categories. The investment beliefs are maybe things that you look at once a decade. So 2023, 2024, we trued up, we tested our investment beliefs. We did it at a board offsite. Prior to that, we surveyed the board. We looked at other statements of investment beliefs from other similarly situated organizations. And from version 1 to version 2, I would say the focus on version 2 is more principles.
Okay.
And that those principles are more extensible and can evolve with markets, with time, with different boards, because the board at LACERA today is different than the board I joined back in 2017. So our statement of investment beliefs talks about strategic asset allocation, as the most important belief of the board. Talks about market dynamics. And part of that is market efficiency or market inefficiency at times. Returns is another pillar. Risk is the next one. So obviously, return and risk are key aspects of any institutional investment program. And maybe strategic asset allocation as the first is the most important, but maybe, number 5, which is governance, maybe that is the first. Maybe governance is the most important discussion in any endeavor, across time. It's not unique to investments. It's not unique to institutional asset management. Governance is the process that effectuates all outcomes. Related to governance, we have stewardship and the importance of stewardship as an investment belief. Terms are things such as the expenses, the rights that we have as an investor. And then the last investment belief is productivity. And productivity really relates to people, to education, and to operations or resources. And maybe one thing when I think about our investment beliefs, there's a lot of overlap between the different components of our investment beliefs.
Yeah, I noticed that human capital, you pull that out and specifically, so you're talking about the team really, and
Yes.
the strength of the team and being able to manage assets. That's great. So we talked about corporate governance and stewardship as well. You mentioned there are 5 asset classes that you're managing across. And it looks like when I'm looking at your IPS and looking at, LACERA's activities in the space, which we should dive into in just a moment, it seems quite integrated into the process, corporate governance, stewardship. Can you talk a little bit about how that sits in your asset classes and how that manifests in general in your overall process and day to day?
Sure. And you started the question with the governance of governance.
Mm-hmm.
And, at some point, I'm happy to go into the governance review by the board at LACERA, and then the next level down being kind of the governance review of the team here that implements the board's policy. But as it relates to the specific question, I tend to give long answers.
Okay.
So this one I'll shorten a little bit, is the way we construct the team at LACERA, and it mirrors how we do diligence. It mirrors how we monitor the portfolio and present information publicly to the board and put on our website, is we have asset category teams. And so, for example, we have a growth team. The growth team looks at equities, public equity, private equity. And when the growth team does diligence, they are supported, complemented by 2 functional teams that we have. And the 2 functional teams we have are our stewardship team. So every time we do diligence or continuing diligence and monitor a business partner, we have questions about stewardship. Others may call it ESG, stewardship, as well as our TIDE program, which is LACERA Towards Inclusion, Diversity, and Equity. So we always have modules about human capital management, people, talent management, whatever you want to call it, because it's critical to our program. As well as stewardship. And then our second functional team that complements our asset category teams is our portfolio analytics team. And our portfolio analytics team is critical middle office functions. It is risk reporting, performance reporting, asset allocation. In many cases, we just started a fellowship program at LACERA. It's a 2-year program. In the first year, the fellows will spend their time in our portfolio analytics team, because I think that the middle office is where you learn about everything in an investment program. So we have a kind of a it's too big a word for me, but I'm going to use it anyway, kind of an orthogonal approach. And maybe we could stop there with an orthogonal approach. And obviously, every organization has to do things their own way. So I speak for LACERA when I say this, because this is something we discussed. There are an approach that others may use, and they may use it well, is to say we have a responsible investment allocation, and this is the team that oversees it. But to the extent, and call that allocation 3 to 5%. to the extent that you believe that you're compelled by fiduciary duty to be a quote unquote responsible investor, to be a prudent steward of your institution, your members, your beneficiaries' capital, you should believe it 100%, not 3 to 5%. And so that's really our guiding principle, is that these beliefs permeate 100% of the capital. It's not a subset of the capital.
That's great. That's really great. And the reason you do this is because you view responsible investment as absolutely essential to protecting and growing assets, right?
To generate the returns that we need to generate, we are compelled. Once again, we'll use that word because I know you like it. So I'll use a word that you like. We're compelled by our fiduciary duty to, as we do diligence in constructing the portfolio, as we monitor the portfolio, to turn over every rock to see if there's any incremental diligence that informs an opportunity such that it's return generating or risk mitigating in terms of a risk that we didn't contemplate by having a more narrow set of diligence. And maybe even more expansive is that this isn't just about how we, pick a private equity firm or real estate. I think it applies also to how, at the very highest level, our primary investment belief in terms of how we asset allocate, because the last several times that we have gone through strategic asset allocation exercises, which are year-long processes, we have included different climate scenarios to challenge our capital market assumptions that, with different scenarios, are returns going to be compressed? Or are they going to be expanded? It's not just risk. Maybe there's opportunities that we should contemplate. And are the volatilities, are those more narrow or are they wider? So we have expanded the data that we use at the very highest level in order to apply judgment in terms of constructing the portfolio consistent with our mission.
Thanks, John. So you're bringing up an important point as well, and lens, in that we are in a changing world. And so using the climate scenario analysis sounds like something new to accommodate or to address some of the changes that we're seeing. Are you doing that in other ways as well? Are there sort of emerging risks and opportunities that you're seeing in your day-to-day?
Change is a constant. To the extent we dismiss change, I think that we're not doing our job. So I think the world is always changing. Our role, our assets, our situation, the opportunity set is always evolving. As it relates to other ways that we're evolving our program, changing our program, and maybe I'll let this be kind of moderator's choice. If door number one, strategic, we talked a little bit about that, but there are other ways to talk about it. The second door may be at the implementation level, and then the third may be operational. And I think that we've done it in all those different ways.
Yeah, John. So let's talk about the strategic dimension here.
Sure. And the changes that we've made strategically, maybe threefold. I mentioned, in our asset allocation, we're climate aware now. The second is the board 18 months or so ago spent 6-9 months doing a governance review of themselves. And it was something as staff we effectively had to recuse ourselves from, importantly, because it impacted us. So the governance is critically important. And the board was aware that the portfolio is more complex than it was 20 years ago. We have exposures across all asset categories, and with data, we can make the most informed decisions.
So it's kind of like the best information, best decisions, sort of garbage in, garbage out. If you don't have the right data, you're already in trouble.
Absolutely. I mean, investments is a forward-looking business. the ability to best position yourself is to have the most information as possible.
That includes information that's sustainability related or often bucketed
Absolutely.
there. So we talked about climate. What about social aspects that you're looking at? You mentioned human capital internally, but are there any other areas where you're just like, this keeps coming up in my portfolio? Let's dive a little bit deeper.
Sure. We have a program that a policy the board adopted prior to 2021. Well, in 2021, the board adopted our TIDE framework towards inclusion, diversity, and equity. Prior to that, going back decades, the board had a variety of different policies. We put everything together such that it was more cohesive and consistent. I guess it sounds like we're very regimented, and we are, because I think that we believe at LACERA that process really matters. There are multiple pillars to our TIDE program, and it's predicated upon the notion that, and this is in our investment policy statement, that diverse teams and diversity is broadly defined as possible that are inclusive and equitably managed will outperform. So this is, once again, it's about performance. It's nothing else there other than we think that the best team, a focus on having quality people both at LACERA and with our business partners, is going to produce the best outcomes.
So really you're looking for inclusivity across the board, but actually embedded in an organization. So
absolutely,
they walk the walk. Okay.
My job at LACERA to focus on building the best organization in the investment division here and partnering with the best firms that are constantly looking to improve, because the scarcity in investments is human capital, maybe more so than financial capital. That financial capital may be the commodity, human capital being the alpha, and that alpha comes from avoiding groupthink and just having as many different perspectives as possible and as much debate as possible in order to best navigate trying times.
That very much resonates. It's the idea of, to have the best team, you really need the biggest pool. And you want to make sure that you're looking everywhere. Yeah. Same in investments and in staff, and then life, maybe in life.
Absolutely.
We've covered a pretty wide berth of how LACERA works internally and how you make investment decisions in general. But one of the things that we often say at PRI and notice that in creating what we call an enabling environment around responsible investment, it's really important to have regulations, regulatory structures, policies in place that allow investors to use responsible investment strategies, to focus on corporate governance, to focus on stewardship to the extent that it satisfies their needs, their focus on risk-adjusted returns consistent with their fiduciary duty and what have you. From a policy perspective, there's been a lot of focus on the United States in particular. I think part of that is, we're the biggest capital markets on earth, and there's a lot of activity here. There's still been quite a bit of movement on data quality. You have IFRS, you have ISSB, trying to find some degree of cohesion and comparability across the board. We talked a little bit about data before, but curious about how the policy environment and these quasi-government, and private bodies help and impact you and the team in their decision-making?
Great question. Sound, well-functioning capital markets are like oxygen for an institutional investment portfolio. So for us to adequately not necessarily price risk, but be compensated for risks and understand the risks that we're taking, we need to have quality information. And we fundamentally believe in transparency. And I think that we practice that ourselves. We post as much as possible on our website and hopefully it's in a digestible, readable manner. But we advocate for and partner with a variety of organizations to hopefully effectuate or result in the clarity of information that you articulated. And I don't know enough to say what is the right standard, but I think standards are important, and you don't want competing quasi-standards working at cross purposes. And I think that there's an opportunity now for different organizations to have pride of authorship is too strong. But, I go back to the beginning of my career, there was GAAP, generally accepting accounting principles. There weren't kind of competing accounting standards. Now, in different geographies, there were different accounting conventions. In many cases, maybe there's an analog from accounting that can apply to data for in the realm of stewardship or responsible investing, that with standards, corporate issuers, companies, institutions, organizations, governments can better compare and regulate that information and have capital markets that are positioned for the future.
How important are shareholder rights, especially in the public markets, to you and the investment process?
We have a stewardship principles that, once again, are on our website. We publish a stewardship report every year where we talk about some of the initiatives with respect to some of our proxy voting, with respect to some of our ownership rights. I would maybe expand the question, not with a rhetorical statement or rhetorical question, but I think that as a fiduciary managing capital on behalf of retirees, that all the economic rights associated with that capital are important. So I don't think it's just limited to voting proxies in public markets. We in private markets, we think that those rights are equally important. And in some sense, there's a bit of an irony in that in private funds, we typically have a larger ownership than we do of what our ownership interest is in a public company. So in a public company, it could be 10, 20 basis points. I don't know what the number is, whereas it's, it's orders of magnitude potentially higher in public markets or private markets, pardon me. So we shouldn't limit our voice to just where it's easier to have a voice, which is proxy voting. I think that it's our duty to be on limited partner advisory committees, to custody our capital as best we can, to partner with firms that are like-minded, that are responsible stewards of capital. So I think that the concept applies to 100% of our portfolio, not just our public equity investments.
Going back to the beginning of our conversation when we talked about definitions and acronyms and how language can get quite muddied in this field. I mean, others too, but I think we certainly have this challenge in our own field. What does back to basics look like?
I think part of the reason why I have issues with language is that we all like easy. Mm-hmm. We short sound bites, play well. We tend to talk in our own echo chambers and hope that and assume that people understand what we're saying. Parsing language, speaking in complete sentences is harder. Yet all of us need to push ourselves to do it. So I think that part of the answer is I think that investing or speaking is hard. So that means that we have to be more aware of the words we choose. Back to basics. I think back to basics is about mission. It's about, every organization needs to best understand what their mission is. For LACERA, it's paying retirement benefits. It's and the way we pay retirement benefits, or to best do that over time for the retired member of LACERA, the person collecting benefit payments today, as well as the person that's starting work on Monday and they're not going to retire for 40 years. We need to construct a portfolio that's going to meet the needs and the needs of everyone in between in terms of the tenure of their career. To do that, we need to go back to basics and asset allocate in a manner that is risk aware. We need to implement those portfolios with different asset categories and choosing business partners, whether we do it ourselves or with business partners, that we seek to be compensated for risks. I think in many cases, we like overcomplicating it because it forces us not to have to explain to third parties if we use jargon, if we speak in code, but just understanding that at the end of the day, we're here to generate returns. That's the basics for us.
That was a great response, by the way. So that's sort of the mic drop moment. Thank you so much for taking the time to connect with us today. It was a lot of fun. It was a lot of fun. I mean, we're talking about some pretty serious in the weeds stuff, but these are the things that are foundational, the governance of governance, to use your phrase. So thank you so much for joining us.
Thank you for having me. It was great to see you.
Likewise. Well, thank you everyone for joining me today, and with special thanks to John for taking time out of his very busy schedule to share his insights with us. Well, we'll see you again in 2 weeks when we have our next episode. In the meantime, if you're interested in following us, please like and subscribe, but we'll see you next time. Thanks so much. Bye.